On December 3, 2024, the COMEX silver market produced the kind of outcome this narrative says JPMorgan Chase has spent 15 years trying to prevent. Delivery notices appeared for roughly 5.2 million ounces of physical silver tied to futures contracts, and the claim is that these obligations could not be rolled into later months, could not be converted into a quiet cash settlement without signaling weakness, and could not be ignored without forcing attention onto inventory and delivery mechanics. The story treats the event as a moment when a paper-heavy market was dragged unwillingly into the physical world that the paper was supposed to represent. If you're interested in personal finance, hit subscribe and give this video a like right now. And now, let's move on. That premise is used to reframe what futures actually mean in this market. Many people assume futures are a practical bridge between producers and consumers, where paper exists mainly to schedule real shipments. The author argues that silver futures on COMEX are primarily a pricing, hedging, and speculation venue, where most participants never intend to take delivery and instead close positions for cash. Physical settlement is treated as the edge case the system is designed to discourage, because widespread delivery would force a hard confrontation between paper volume and physical stock. To quantify how rare delivery is supposed to be, the text leans on COMEX settlement history and repeats a figure it treats as foundational. According to the numbers it cites, around 95% of silver futures contracts historically settle in cash, not in physical bars. In plain terms, out of every 100 contracts that can legally end in delivery, only about 5 typically result in metal changing hands, while the other 95 are netted out in dollars. The argument is that this habit is not an optional detail because it dictates whether vault inventories need to be deep or merely symbolic. Once cash settlement dominates, the story says the system begins to resemble fractional reserve finance applied to precious metals. If only a small minority insist on bars, then a large intermediary can issue far more deliverable claims than it could satisfy simultaneously with bullion in a vault, because the crowd usually self-selects into cash. The narrative describes this as a convenient situation for banks because 100 paper promises can be supported by a thin layer of registered metal. The arrangement holds as long as the settlement behavior holds, which is why the author treats the 95% figure as the market's load-bearing wall. In this telling, JPMorgan did not merely participate in the structure, because it allegedly positioned itself to control the points where the structure could fail. Between roughly 2010 and 2020, the bank is described as the largest vault operator on COMEX for silver. And the narrative asks why the biggest bank in America would want to run warehouses full of bullion. The answer offered is control, because controlling vaults means controlling the delivery process itself, and delivery is the moment when paper promises meet physical constraints. When almost nobody demands bars, the vault looks like boring infrastructure. But when delivery spikes, the vault becomes the bottleneck that determines whether the system is credible. A technical distinction is central to the story's mechanics: registered versus eligible inventory. Registered metal is described as silver allocated and approved for delivery against futures, meaning it is ready to ship once delivery notices are issued. Eligible metal is described as silver stored in COMEX-approved warehouses, but not designated for delivery, often because it is privately owned or reserved for other purposes. The narrative argues that a dominant warehouse operator can exploit this labeling by shifting metal between categories, or by moving inventory internally in ways that create the appearance of ample supply without forcing new metal to arrive. In ordinary times, this can look like normal operations, but the story frames it as a tool for managing the optics of scarcity when delivery is supposed to remain rare. The text then introduces what it treats as the quiet breaker of the old equilibrium: Basel III banking reforms. In June 2021, Basel III went into effect across Europe, and the narrative says a phased rollout influenced broader markets in subsequent years. Inside those reforms, it claims, was a reclassification that hit unallocated precious metals, meaning paper claims on metal that is not specifically earmarked for a particular owner. The story translates the technical language into a practical effect. Banks can no longer treat paper metal promises as high-quality balance sheet assets in the way they once did. In its framing, the rules did not announce themselves with fanfare, but they change what banks can comfortably carry during stress. In the narrative's framing, Basel III did not ban paper markets, but it changed the incentives and the compliance math. If unallocated claims are treated as low-tier assets, then building a massive derivatives book supported by other paper becomes harder to justify under capital and liquidity rules, especially during stress when counterparties may demand delivery. The author portrays this as the end of the old paperbacks paper comfort, because the regulatory regime nudges banks toward holding real, deliverable metal rather than a chain of promises that collapses when someone insists on bars. The key is not morality, but arithmetic under new constraints, where the old strategy becomes less resilient once the market turns physical. The story then ties the visible break to a price threshold near $59 per ounce. This number is not presented as mystical, but as a level where multiple forces align. Miners begin withholding exchange deliveries, international arbitrage pulls metal toward higher physical prices in Asia, and industrial buyers stop waiting for dips and start locking in supply. The author suggests that once these forces activate together, the market's default behavior of choosing cash settlement becomes unstable because the incentives to demand delivery grow stronger for exactly the actors who cannot substitute cash for metal. In that environment, the exchange's assumption that you'll take the dollars becomes a fragile bet rather than a reliable habit. The first pressure point is the production side. Around $58.50, the text claims, silver becomes profitable enough that producers such as First Majestic Silver and Pan American Silver can choose direct sales to industrial buyers rather than delivering into COMEX warehouses at exchange pricing. The narrative frames this as a strategic shift. If manufacturers will pay premiums for guaranteed supply and schedules, then feeding the exchange channel becomes less attractive. The practical consequence is that fewer fresh ounces arrive to refill deliverable stocks, which matters most when inventories are already thin. The story treats this as a quiet withholding of supply from the paper venue, not because production stops, but because the channel changes. The second pressure point is framed as simple arbitrage rather than ideology. The text points to the Shanghai Gold Exchange, where physical metal trades more directly in the Asian market, and claims that during November, silver reached the equivalent of roughly $62 per ounce in yuan terms. If COMEX sits closer to $59, that spread creates a straightforward trade. Buy metal from the cheaper pool, ship it east, and sell it into the higher-priced pool. The story claims this spread mattered because it allegedly produced a measurable drain, with COMEX inventory declining by about 4.1 million ounces in November as metal flowed toward the better physical price. The framing is that geography and math can pressure a vault even when domestic traders remain comfortable with paper. The third pressure point is presented as the most consequential because it comes from buyers who cannot accept cash in place of metal without disrupting real production. Solar panel manufacturers, electronics firms, and electric vehicle producers are described as needing silver as an input, not as a trade. Their procurement managers must secure material for 2025 manufacturing schedules, and those schedules collapse if shipments fail. The narrative describes a behavioral shift. At $58, procurement teams might hope for a pullback, but at $59 they start treating availability risk as more expensive than price risk. When the penalty for missing a production target dwarfs the cost of paying a premium, the rational move is to buy now and insist on delivery. The story claims that this procurement behavior changes the market structure because it removes the comfort of cash settlement. When industrial users demand delivery, they pull bars out of the system rather than recycling paper positions into dollars. In that framing, industrial buyers stop being passive counterparties who allow paper traders to exit cleanly and instead become direct competitors for a shrinking pool of deliverable metal. If enough industrial demand shifts into delivery, the author argues, the market stops being a liquid paper arena and starts behaving like a supply chain under stress. The exit liquidity that paper traders rely on disappears because real users do not close for cash when they need bars. With that context set, the story presents JPMorgan's trap as a problem of scale and timing. It claims that between 2008 and 2020, the bank accumulated about 947 million ounces of paper short exposure, drawing on CFTC commitment of traders data for the scale of the position. The alleged strategy is described as simple: take the short side of futures, collect the economics of the position, and rely on the market's habit of cash settlement to avoid delivering metal on most contracts. Vault control is framed as the operational lever that made this strategy stable for years, because the rare delivery events could be handled through internal inventory management rather than through scrambling for fresh supply. Basel III and the $59 price regime are then framed as the forces that drag the paper strategy into the physical world. The story says JPMorgan's vault inventory peaked around 47 million ounces in early 2023 and fell to roughly 8.9 million ounces by late 2024, describing an 81% drawdown in less than 2 years. It then says registered inventory across all COMEX vaults sits near 28.4 million ounces, which it translates into only about 8.4 days of coverage at the delivery pace it claims is current. In this framing, inventory is no longer a background statistic, but the central constraint, because the market can only deliver what exists in registered form. The combination of shrinking vault stocks and rising delivery pressure is presented as the mathematical heart of the crisis. The author then emphasizes a feedback loop that grows harsher as inventory falls. If JPMorgan delivers bars to satisfy one set of notices, those bars leave the vault and reduce the physical backing behind the remaining paper promises, increasing the stress on the next notices. If the bank refuses delivery or pushes hard for cash settlement, the narrative argues that it confirms the market is under-collateralized, which motivates more contract holders to demand metal while it is still available. Either path makes the next step worse, because delivery drains inventory and refusal drains trust, and the system needs both to remain stable. In the author's telling, the trap is that the bank cannot satisfy the market without weakening itself, and cannot resist the market without teaching the market to run. To make this logic intuitive, the story uses a check-writing analogy. Imagine writing 100 checks for $1,000 each while keeping only $5,000 on deposit, because only 5 checks are usually cashed. As long as people trade the checks among themselves and treat them like money, the shortage stays invisible. If rules change and people begin cashing checks because they suspect the account is thin, the shortage becomes immediate and self-reinforcing, because refusing payment only persuades more people to cash sooner. The story argues that COMEX can behave similarly when holders decide delivery is the only way to secure value, turning a routine market into a run on a finite pool of bars. Because this kind of argument often gets dismissed as a conspiracy narrative, the author repeatedly insists it has documentation. The first set of receipts is the CFTC Commitment of Traders reports, described as weekly disclosures showing who holds major long and short positions. The story claims these reports show JPMorgan held a concentrated short position that averaged about 32% of the entire COMEX silver market from 2010 through 2024. It emphasizes that such concentration is unusual because position limits exist to prevent a single actor from dominating a commodity market. In the narrative's framing, the size alone should have been a flashing warning, regardless of anyone's opinions about motivation. To make the concentration vivid, the text points to March 2020, claiming JPMorgan held about 40,550 contracts, which it converts into roughly 202 million ounces of silver exposure. It contrasts that figure with a stated COMEX silver position limit of 9,000 contracts and asks how the bank could exceed the cap by more than 4 times. The narrative's answer is an exemption. The short was classified as hedging, tied to vault operations and banking services, allowing the bank to argue it was offsetting legitimate business risk. The author portrays this as a closed loop because vault operations that make the position possible are then used to justify the position's size. In that framing, the rule becomes a tool rather than a guardrail. The second set of receipts is the spoofing settlement in 2020. The story says that in September 2020, JPMorgan agreed to pay about $920 million to settle charges with the Department of Justice and the CFTC related to spoofing in precious metals. Spoofing is described as placing large orders intended to move prices by creating a false impression of supply or demand, and then canceling those orders before execution once the market responds. The The narrative claims the investigation documented thousands of such incidents between 2008 and 2016, and treats the size of the penalty as confirmation that manipulation was not theoretical. It then argues that the settlement did not solve the structural problem of concentrated positioning, which is why the bank remains central to the story through 2024. From there, the story returns to late 2024 and interprets a position decline as evidence that the bank is being forced to change behavior. It says that in November 2024, for the first time since 2008, JPMorgan's silver short position fell below 15,000 contracts. The author insists this is not a voluntary retreat, but a forced reduction driven by physical deliveries that cannot be papered over anymore. The paper game, the story argues, could run for years because it rarely had to become a physical game, and because most holders were content to close for cash. Once delivery becomes the center of gravity, shrinking the paper position becomes harder because the act of covering collides with the need to source real bars. To show how physical settlement can break a paper structure, the text reaches back to the Hunt brothers episode in 1980. It recounts that Bunker Hunt and Herbert Hunt accumulated about 59 million ounces of physical silver between 1973 and 1980, pushing prices from roughly 6 per ounce to around 49 to 45. It then notes that 49 and 45 in 1980 translates to about 187 in today's dollars after inflation adjustment, using that as a benchmark for how far a squeeze can push prices when shorts are forced to cover in a market with limited deliverable supply. The point is not that history repeats perfectly, but that physical claims can overpower paper assumptions when enough holders insist on metal. The narrative then explains how that earlier crisis ended, arguing it ended through rule changes rather than through new metal appearing. It claims that on January 21, 1980, COMEX introduced an emergency measure often referred to as Silver Rule 7 that restricted new long positions, forcing liquidation and limiting participation to closing trades or hedging. The result, the text says, was a collapse in price, with silver falling from the high 40s to below $11 within 4 months, bankrupting the Hunts and protecting the short side. The story uses this as proof that exchanges can change rules when they face existential stress, and it frames that history as the reason many observers assume the same thing would happen again. Then it argues today's situation contains a critical difference that makes repeating the 1980 rescue harder. It claims current open interest represents about 862 million ounces of paper, claims across COMEX silver contracts, which the narrative describes as roughly 14 times the Hunt's accumulation. It also argues that today's delivery pressure is not a single family that can be targeted, but industrial supply chains that cannot be bankrupted without broader economic damage. Most importantly, it claims Basel III sits above exchange bylaws as international banking compliance, meaning the easiest just change the rules. Trick is constrained by balance sheet treatment and regulatory expectations across jurisdictions. In that framing, a local rule cannot cleanly cancel a global compliance problem without causing different failures. To support the claim that JPMorgan understands this bind, the narrative points to the bank's SEC filings and internal risk language. It says that in Q3 2024, JPMorgan's precious metals derivatives exposure decreased by about $14.7 billion, while physical metal holdings increased by roughly 2,100 tons. And it interprets that combination as institutional urgency rather than routine portfolio rotation. The story also points to risk management language in filings and paraphrases it as a warning that physical delivery demands may exceed available inventory during periods of market stress. In its tone, this is corporate lawyer language for a problem that the market prefers not to discuss, and the author argues that it is hidden in plain sight because most people never read it. After the evidence section, the narrative turns into a simple inventory arithmetic exercise meant to show inevitability. As of December 2024, it says registered COMEX silver inventory stands around 28.4 million ounces, while eligible inventory is about 186 million ounces. It stresses that eligible is not the same as deliverable, because it is merely stored in approved warehouses and may not be committed for delivery. Against this inventory, it converts total open interest into about 862 million ounces of paper claims, producing a ratio It frames as roughly 30 paper ounces for every registered ounce. The story treats that ratio as the quiet reality beneath the market's liquidity, because paper volume looks safe only while most holders keep choosing cash. To show how small a behavioral shift can trigger failure, the story runs a modest scenario. If only 3.5% of open interest demanded delivery, that would equal roughly 30.2 million ounces, which already exceeds the 28.4 million ounces in registered inventory. The point is that the system can fail even if delivery demand stays below the historical 5% delivery rate, because inventories have thinned until there is no buffer. In this telling, the market is not waiting for everyone to demand metal. It is vulnerable to a few people out of 100 changing their minds. That is why the author treats the December notices as dangerous, even if most participants remain cash settlers. The December delivery notices are then used to build a timeline. If deliveries continue at roughly 5.2 million ounces per month, the narrative says the registered pool could be depleted in about 5.4 months, pointing to May 2025 as the mathematical endpoint. It immediately argues that this is conservative because runs accelerate once participants see inventory shrinking and fear being last in line. If monthly deliveries rise towards 7 million ounces as panic builds, the story says the exhaustion point moves into March or April 2025. The author's broader point is that depletion is not linear under stress, because the mere observation of depletion changes behavior and increases the pressure. The narrative also argues that shifting metal from eligible to registered is not an easy escape hatch. Eligible bars may be owned by entities that do not want to deliver, so conversion requires consent, or it requires buying metal in a tightening market. Even when conversion happens, the story argues that it signals stress by revealing that the deliverable pool must be rebuilt by scavenging stored metal rather than by steady inflows of new supply. That signal encourages more holders to demand delivery quickly because it advertises that the system is running on fumes. In that framing, eligible inventory is described as a mirage that looks reassuring until the market tries to turn it into registered inventory at scale. Then the story addresses the intuitive objection that higher prices should attract new supply and solve scarcity. It cites projections attributed to the Silver Institute and mining forecasts, claiming industrial demand for 2025 sits around 642 million ounces. It highlights solar panel manufacturing as a major driver requiring about 247 million ounces, and it ties that to expanding renewable capacity targets, which it says increases demand by roughly 49 million ounces from 2024. It also mentions electric vehicles, claiming they use about 25 to 50 grams of silver per vehicle in components, and it translates projected production volumes into tens of millions of ounces of incremental industrial demand. The narrative's point is that industrial consumption is not a small side market anymore, but the anchor that steadily absorbs supply. On the supply side, the narrative claims global mine supply for 2025 is projected at about 843 million ounces. If industrial demand is around 642 million, the remainder is about 201 million ounces available for investment, coinage, and exchange inventories. And the author argues this remainder used to be far larger. The story cites a surplus near 340 million ounces in 2020 and frames the shrinking cushion as the reason paper markets have become less stable, because less surplus metal is available to refill vaults when inventories drain. It also argues that miners and industrial buyers increasingly prefer direct contracts with premiums, which keeps metal out of COMEX warehouses and makes replenishment harder. In that framing, supply exists, but it does not necessarily flow into the place that needs it for paper settlement to remain comfortable. With those constraints established, the narrative turns to how short squeezes behave when physical scarcity becomes undeniable. It uses the Volkswagen squeeze in October 2008 as a template, describing a three-stage pattern where price rises gradually during accumulation, pauses while shorts attempt to cover, and then spikes vertically when the market realizes the underlying asset cannot be sourced. The author claims silver already completed the first phase, pointing to the rise from roughly $18 in 2020 to around $59 as a gain of about 327% over several years. It frames the present as the consolidation and covering phase, where large shorts try to reduce exposure while physical demand keeps tightening the noose. In that setup, the vertical move is framed as the final phase that begins when the market accepts that the metal is actually scarce. Stage 3, the author argues, begins when registered inventory drops below about 10 million ounces, because that level represents only a short coverage window at current delivery rates. At that point, the narrative says, price changes stop being incremental because the marginal buyer is no longer a trader comparing returns, but a manufacturer preventing a shutdown. A procurement manager responsible for a billion-dollar production line compares silver's price to the cost of missed output, not to a chart of historical ratios. When real users compete for the last available bars, the story argues, prices do not climb politely. They gap upward because the alternative is operational failure. In that framing, vertical price behavior is not hysteria, but a rational bid for scarce inputs. To translate that logic into numerical outcomes, the text offers 3 price bands as scenarios rather than a single-point forecast. A conservative scenario places silver in the $120 to $150 range, framed as the gold-to-silver ratio returning toward a historical average near 40-1, with gold around $4,000 implying silver near $100 before adding a tightness premium. A moderate scenario places silver around $200 to $250, framed as revisiting the inflation-adjusted 1980 peak near $187, and adding a premium for today's much larger industrial demand. A more extreme scenario places silver in the $295 to $350 range, framed as the price region where industrial panic buying would likely appear because the cost of production delays overwhelms the cost of metal. The author presents these ranges as the shape of a squeeze rather than as a precise forecast, emphasizing that physical scarcity tends to overshoot because buyers pay whatever clears the market. The proposed timeline centers on the second to third quarter of 2025, roughly 6 to 9 months after the late 2024 delivery pressure described in the story. The author allows that the precise month could slide if deliveries slow temporarily due to negotiated settlements, or if short covering stretches the consolidation phase, but it insists the math does not change. In a structure where there are roughly 30 paper claims per registered ounce, the narrative argues, the system survives only as long as holders remain willing to treat paper as sufficient. Once behavior changes, the ratio stops being an abstraction and becomes a countdown. In that framing, timing is flexible, but the endpoint is not, because physical inventories define the boundary. One more thread the narrative pulls is the idea that delivery stress accelerates once it becomes visible, because the rational strategy changes for anyone holding a claim. If delivery notices keep arriving in multi-million ounce blocks, then a holder who might have accepted cash last year has an incentive to demand metal now, simply to avoid being behind the wave. The story treats this as a vault-run dynamic rather than ordinary settlement, because the attempt to secure bars earlier becomes self-fulfilling, as more holders act the same way. In that environment, the May 2025 depletion estimate based on 5.2 million ounces per month is framed as a midpoint, not a ceiling, because accelerating demand can pull the timeline forward into March or April if monthly deliveries approach 7 million ounces. The author also argues that JPMorgan cannot unwind a concentrated short position cleanly without pushing prices higher, which is why it frames forced delivery as the most painful form of covering. When a short buys back paper, it can sometimes do so quietly over time. When a short must deliver metal, it must source bars in the very market that is becoming tight, which raises the cost of every subsequent ounce. This is why the narrative interprets the combination of a shrinking short position and rising physical accumulation as defensive rather than opportunistic, because the bank is portrayed as preparing for a world where paper settlement is no longer enough. In that world, the story says, even small errors in inventory accounting become major signals because they tell participants whether eligible metal can actually be coaxed into registered form when the line forms at the vault. Near the end, the narrative returns to JPMorgan's dilemma and insists there is no comfortable play left. If the bank delivers metal promptly, every ounce shipped reduces the backing behind the remaining paper promises, which makes the next notice more dangerous than the last. If the bank refuses delivery or leans aggressively on cash settlement, it risks confirming to the market that the emperor has no silver, which encourages more holders to demand bars while they still can. In this framing, each response accelerates the run, because delivery drains inventory and refusal drains confidence, and both are fatal in a system that depends on confidence. The story adds a regulatory constraint to explain why the usual change the rules. Escape hatch is portrayed as weaker than it was in 1980. COMEX bylaws can be rewritten, position limits can be massaged, and settlement conventions can be encouraged. But Basel III is presented as international banking compliance rather than a local exchange preference. The author argues that a modern version of Silver Rule 7 would collide with bank balance sheet treatment of precious metals exposure because the capital and liquidity rules are enforced across jurisdictions and cannot be suspended by an exchange committee without broader consequences. That does not mean authorities are powerless, but it means the easy fix of simply banning demand is framed as harder when demand comes from industrial supply chains rather than from a single speculator. At this point, the narrative emphasizes why the contract mechanics matter. A standard COMEX silver futures contract represents 5,000 ounces. So, open interest measured in contracts is also a count of outstanding delivery promises once multiplied by that unit size. When the text converts open interest into 862 million ounces, it is not claiming that every ounce will be demanded at once, but it is insisting that the legal right exists for holders to demand delivery, and that the market stability depends on most of them choosing not to. The entire paper structure in this telling is a behavioral equilibrium, not a physical equilibrium. The author then circles back to the same narrow tipping point that runs through the story. Only a small percentage shift in behavior is enough to overwhelm registered inventory. If miners route more output to direct industrial contracts, if arbitrage continues pulling bars toward higher-priced physical venues, and if manufacturers decide that supply certainty matters more than price timing, then more than the usual 5% will press for delivery. Once that happens, every delivery notice becomes a referendum on whether COMEX is a price discovery venue or a cash-settled derivatives game with a metal-themed wrapper. The story suggests that the market will test that question aggressively once participants believe the window to receive metal is closing. To keep the argument grounded, the narrative insists it is not asking for belief, only for attention to the published numbers. COMEX inventory reports distinguish eligible from registered. Delivery notices are recorded as contracts move into the delivery month, and CFTC reports disclose whether a single entity holds an unusually large share of the short side. Even the bank's own filings are treated as part of the trail, because reductions in derivatives exposure alongside increases in physical holdings are interpreted as a sign that the institution expects delivery risk to matter more than it used to. In that sense, the story portrays the December 3rd notices not as the finale, but as the first visible crack in a long-running assumption. The concluding claim is that the paper era survives only while most participants prefer dollars to bars, and that preference is what price, regulation, and industrial demand are now eroding. Once enough holders decide to demand silver, the paper claims have to meet a finite pool of deliverable ounces, and the gap cannot be negotiated away forever. In the author's final tone, the situation is not a mystery and not a theory, but an arithmetic stress test, playing out in public tables. With JPMorgan caught inside a structure it helped build and cannot unwind without either draining its vaults or exposing the limits of cash settlement.